Okay, good afternoon. This will be our last video as of comprehensive exam number 2. And probably we will be back again with the upcoming lecture videos by next week. So at this point, let me give you some reminders, starting with job order. So topics pertaining to cost accounting. So number 1, job order. At this point, you know very well the cost flow, the usual entries encountered in job order costing system, starting with upon purchase of raw materials on account. So debit raw materials inventory and credit accounts payable. Materials issued to production will be debited to work in process as to direct materials, factory overhead control as to indirect materials, and raw materials inventory. Then, if in case returns, there will be returns from factory to storage area, then simply debit raw materials inventory and credit work in process if the returns pertains to direct materials, and credit factory overhead control if the returns will pertain to indirect materials. Otherwise, if returns will be returned to the supplier or vendor, then debit accounts payable and credit raw materials inventory. As to payroll distribution, again, we debit work in process. First, we need to incur labor, so by debiting payroll and credit accrued payroll, or debit salaries and wages and credit salaries and wages payable. Then upon distribution of that labor incurred, we debit work in process as to direct labor, debit overhead control as to indirect, and credit payroll account. Then again, with the assumption of we are using normal costing based on a predetermined overhead rate, which is again computed on the base of the numerator, which is annual budgeted overhead costs over annual budgeted activity, usually direct labor hours or machine hours. Take note if plant-wide or departmental overhead rates are involved. So that predetermined overhead rate is the basis in applying overhead as to production. So direct material use, direct labor incurred plus overhead applied is again total manufacturing cost. So the total amount of work in process debited during the period is the TMC. Added with the work in process beginning, the costs incurred for the jobs incurred last month is total goods put into process. Less the work in process at the end is the cost of goods manufactured or the cost of goods completed during the period, which is debited to finished goods inventory as we credit work in process inventory. Then from CGM, we add finished goods beginning, the cost of goods completed last month, last period, available for sale. Then finished goods at the end equals CGS at normal costing. So find out if after comparing the overhead control, total overhead control, indirect materials, indirect labor, other actual overhead, the so-called various accounts. Then compare it with the overhead as applied. The overhead applied is more than the actual. Then over applied is deducted from CGS, again if immaterial. Otherwise, we prorate the over or under applied. We deduct over or we add under applied to CGS with finished goods and work in process if in case material. Again, when it comes to spoilage and defective units, when we rework defective units, those units become good units again, but the rework cost is either debited to work in process if in case charged to a particular job, otherwise it will be debited to factory overhead control if it will be charged to an inefficient production. For spoilage, the amount of, if it is because of an inefficient production, the amount of the unrecoverable cost will be debited to factory overhead control. the amount of spoilage to the extent of recoverable amount is debited to spoiled goods inventory. Otherwise, if the spoilage is because of a particular job, then the unrecoverable portion will be part of the finished goods. So we expect that the cost per finished goods will increase. Okay, for process costing, at this point, you know very well the computation of EUP, measurement of work done in terms of units. So, of course, units in process beginning plus units started in process. If in case of first department, units to be accounted. So as accounted, it's either prepared using FIFO, the more accurate method, or average, which is the method which tends to overstate the EUP. So as accounted, it would be transferred out in process at the end, and loss units divided between normal, within expectations, and abnormal if in case beyond. So discrete, if there is an inspection point, we consider the inspection point to be able to determine the extent of the work done in terms of the loss units as to materials and the over conversion cost. And if it is continuous, then we apply the method of complete neglect for the normal loss units. We extend it to 0, the EUP, and otherwise if abnormal, 100%. So, okay, these are purely reminders, you know exactly the procedures at this point, you know the concept behind. So, as to process costing, be ready to again review the combination of continuous FIFO, continuous average, discrete FIFO, discrete average. So again, if it is the loss is discrete, we expect an adjustment on the cost of the units transferred out, or if in case they already inspected, the cost of the units in process again. But otherwise, if continuous, the unit cost in itself are already adjusted. So, okay, last, the joint and byproduct costing. So, joint cost is again to be allocated only to main products because they are the very reason why we engage in a joint processing. The incidental output is the byproduct. As long as significant, its NRV may be deducted from joint costs before any remaining joint costs be allocated to the main products. So we allocate joint costs to main products either using physical measurement, which is unchanging yardstick as the grams or the weight, the kilos, the ounces, the tons, as we understood many years ago, is still the way we understand today. But if it is something changing yardstick, it is more favored because it considers the revenue generating capability of the unit. So we use the monetary measurement. It's either sales value split off, the NRV at split off, or the approximated NRV. So we consider we consider the main products to be saleable beyond split off or after the point of separation only if incremental revenue is more than the incremental cost or if there's an incremental profit. So that's it for cost accounting. Then again for IFRS 15, step 1 is to identify the contract. Make sure it has commercial in substance. It is commercial in substance. Then to be valid, the collectibility of the balance is reasonably assured. The down payment, upfront fee is non-refundable. Then the obligation to both parties is clear, something enforceable. Then step 2 is that we enumerate the performance obligations. Then step 3 is we identify the transaction price. Step 4, if needed, we allocate the performance obligations. And step 5 is revenue recognition. Either we recognize revenue at a point in time or over a period of time. So in long-term contracts, the contract price, which is basically fixed, may change because of contract variation or change in design. Because of delay caused by the contractor, we have penalty. Because of early completion, we have incentive or reward. Then, of course, cost escalation if in case raw materials will increase beyond the control of the contractor. So, which means there are a lot of reasons for a contract price which basically fixed may change. So we consider the probability weighted or the possible outcomes as early as year 1. We use either probability weighted if there are more than one possible outcomes. Otherwise, we use the most likely amount. It's either 100% or 0. Then, of course, it is assumed that reasonable or dependable estimates are available. That's why we use cost-to-cost method, input measures, or percentage of completion. Then, be reminded that anticipated loss is to be recognized immediately in full. We don't use the percentage of completion in recognizing the anticipated loss. But of course, because of dependable estimates, we use the percentage of completion in recognizing the portion of the contract price recognized as revenue in a particular year. For franchise, be ready to dissect the initial franchise fee. It may involve more than one performance obligation, such as service, if in case of training to employees, sales revenue if sale of raw materials or equipment, or probably construction of a building, and the usual intellectual property, trademark, trade name. So we have to be informed of the status of those services, part of the agreement at the end of the year, to be able to determine up to what extent we are to recognize revenue. Of course, also consider the royalty fees, continuing franchise fee for the total franchise revenue. Then, okay, after the cost accounting, the IFRS 15, the home office branch again, when the home office ships merchandise at a markup based on cost, then in the books of the home office, allowance for overvaluation is credited, which represents the markup, which is initial and realized. It will accumulate the markup from the shipments last year of the home office to the branch, and the markup made this year by the home office of the branch will accumulate, and it will be labeled as allowance for overvaluation before adjustment. By the end of the year, the required balance of the allowance is the markup on the ending inventory of the branch as to the extent of the merchandise coming from the home office. That's why from before adjustment, after adjustment, we need to adjust the said account by debiting in the books of the home office the allowance for overvaluation, which is the realized markup, and also by crediting income summary branch. In that way, the income of the branch from its books, which is basically understated, although we expect it's already adjusted for the reconciling items. So to make it from in the books of the branch from unadjusted to adjusted but understated. But in the books of the home office from being understated, before it will enter its retained earnings, the home office retained earnings, it must be already the true income of the branch or the net income of the branch as far as the home office is concerned. So take note of the reminders. If the markup is only true for the year, probably different markups are being made by the home office, the branch every year. So be careful. Then of course be reminded with the debit memo or credit memo again to notify the other party. A memo will be sent to the other party, and it will be labeled according to what the origin did to its reciprocal account. So if the home office will debit investment in branch, since it allocated expenses to the branch, then the home office will send a debit memo to the branch, and the branch, upon receiving that debit memo, being the recipient, will credit its reciprocal account as the branch will debit expenses. So this is a friendly reminder. Now take time to relax and to prioritize first our safety, and again we will be back with the same form of discussion by next week. Keep safe, everyone.